Good morning, investors. This is going to be the start of a new series I'm going to call Investing Algorithms. And the purpose is going to be a practical application of some of the strategies that you can put on for options. I'm going to start off with my weekly account overview, and then we'll get into the strategy for the week. This week will be a rolling strategy. So as you can see, last week I eked out a small profit, $94. It was a pretty red week last week. There was a big drop off in the SPY. So, not upset about coming out green this week. The specific position I'd like to talk about is Workhorse. And I have several positions that I put on as cash secured puts for Workhorse. So let's go in to the mobile view. You can see here I have 2 positions at $12 and 3 positions at $12.50. I sold these a couple weeks ago when the price was at these levels, around $12. The price has since dropped. So I'm looking to see if I can get a better deal. So there's a couple strategies that you could possibly put on. I considered turning these into like a straddle or strangle type scenario, but from what I see, I think it is in my best interest to roll these down in price and out in time. And that, for a cash secured put, is, in this situation, a good alternative to being assigned on the 28th. Now I still have, today is the 16th, so I have 12 more days to watch the price of Workhorse and see where it goes. So let's first step in to the option chain and see where the prices are today. And we can even look at the chart and see if those option chains make sense. Because that is going to be the entire purpose of this series, is to see what method applies to the given situation and to think programmatically. I have this strategy and I see this situation. Does it apply? So I'm going to go ahead and pull up the full view of Webull. It'd be a little bit easier to see the option chain. So my positions are here. May 28th, there's the -3, there's the -2. I was considering rolling these further out in time. I have in my notes to check October and December, because those are the prices that looked good to me. As you can see, as I showed you in the mobile view, we'll look at it here again. I have unrealized losses, which basically would mean I would have to purchase these at a much higher price than the stock is currently worth. The total it would cost me to buy these back at this point is a total of $2,320. For the 12.5, I have 3 positions. The last price was $468. do the math together so you can see kind of how to calculate this. Again, think in terms of premium. That $4, it looks like $4.68 actually will cost me to buy back $468 per option contract. We'll multiply by 3. At the current price, $1,404. Same goes for this one. Last price was $408. There's a discrepancy there. Unfortunately, there's a discrepancy in what Webull says is the last price between here and here. So I'm going to adjust my math to go at what people are actually buying and selling these for. Because unless you have a buyer on the other side at that price, it's not going to matter what you try to sell it at. Same thing as a buyer. There's not a seller on the other side at that price. You won't be able to get that price. So we can see here the $12.50 one has a bid of $445 and an ask of $490. So we could Monday, again, it doesn't have to be Monday. I have some time left on these. And these are outdated prices because it is the weekend. But let's go, for the sake of argument, that I was going to buy this back at the ask. I have sold them in the past. Now I have to buy them back. So now that math comes out to $1,470. Let's do that again. Because let's think in terms of premium. $490 times 3. 1,470. Which is the number I have written down. Same concept for the $12. $425. I only have 2 of those. $850. So if I want to maintain a position in Workhorse with the same cash secured put strategy, I will need to buy these back, and it will seem like a realized loss at first, because I'm going to be paying out $2,320 to buy them back. What I can then immediately do is go further down and further out in time. So let's take a look at October. Again, I may be able to see if there's something closer in time, so I don't have to roll out as far when Monday comes, or anytime next week. The market moves up for Workhorse next week. I may be able to get some better deals. So let's look at the $10 strike price. Here's the $10 strike price. People are willing to buy at $3.45, which means if I were to sell at $3.45, now I have 5 contracts on a workhorse. So let's do 345 times 5. So I would recoup 1,725 of those dollars. Still a loss of around $600. Not great, but in my opinion, better than owning at that $12 mark and having to wait so much longer and sell covered calls against them above that cost when the market demand is not at that cost. So let's check even further out. Again, the market is a marathon, not a sprint. October isn't that far away. How about December? December is far enough out. We can get some decent deals at the $10 and $11 mark. So let's go all the way up to $11. The theory here would be that gives it much more time to build the base of where it's at and come up to those levels. So let's start with the $11. People are willing to buy at $4.25 or $425. And I want to recoup 5 contracts. $2,125 minus my 23 minus my 2320. That is only a loss of $195. So my realized loss has come way down. And if I get assigned in December, or possibly I roll these around in a different manner in the weeks to come, that $195 is now much easier to recoup. I've deleveraged my current position into new positions that are much more in line with the current market price. So let's take a moment to look at the charts and see what price levels, if these price levels make sense from a technical analysis point of view. So I have the workhorse chart here on the daily time frame. And we can see it is still in a downtrend. But let's see if we can find the bottom of this trend from past data. These prices seem to be quite low compared to what it has been. It has been above this level ever since mid-2020. And it has come down. It came up, had several gaps up. That's another thing failed to mention in some of my other videos is to mine the gaps. These gaps have a tendency to fill back down. But in situations where it gapped down, it could fill back up. So let's go ahead and draw a horizontal line from the past year at these levels. So here's one around $6. Let's make this one green. I like to make my supports green. Let's draw the top of this channel around this $10 mark. Let's make this red. Now we have some reasonable levels to work with here in our current time frame. We can also see this large move down. It has dropped off significantly this year. Which means there'll be quite a bit of resistance up here above this line, because it traded sideways for so long. There's a lot of people up here holding these. So let's zoom in. Again, the levels I'm talking about are around this $10 and $11 mark. So in the long term, if it trades sideways in this channel, it can build that base of support in this area and eventually fight its way back up through this resistance. But it is currently underneath all of our moving averages. These moving averages are stacked against us for any future uptrend. I have the 8 EMA underneath the 20, underneath the 50, underneath the 200. That is quite a bit of resistance. Typically, if you're looking for the beginning of an uptrend or something that is already in an uptrend, you would like them to be stacked the other way around. You want your largest moving average on the bottom. So you would want it to be 200, 50, 20, and 8. But my price levels that I discussed in the option chain at $10 or $11 seem to be holding water. $10 seems to be a reasonable price on this daily chart. And it has come down and has found a bit of a bottom, which means it could wave back up here, even in the short term. So come next week, I might not have to go as far out in time. Let's check some other indicators to be sure that they agree with this theory. So we have the MACD. It's currently crossed over, still bearish and descending. but it is also underneath the zero line. It has been underneath the zero line for quite some time. We had this long flat period here that has created some resistance for us. But because we had this large move, this large amount of energy expended to the downside, we can possibly expect another green coming soon. Let's see what the stochastic says. The stochastic is below the 20. Many people say below the 20 is quite oversold, and above the 80 is overbought. So when it is oversold and down, that is a buy signal, or at least a decent buy signal. So again, this indicator adds some weight to our theory that this price can head back up. Let's check the ATR. The ATR is currently quite low, which can essentially mean it's been storing some energy to use again in a future move. This stock typically moves around $1 a day. It is at $8. So it might take the next week or two to move that much. Now, as we saw in the past, that energy can be used to... This is not a directional indicator. The ATR is not directional. Let's get this a little bit larger. Let's make this a bit larger so that we can see. This gives you no indication of direction. It could be storing that energy to move yet another $1 down, further into those 7s, 6s, all the way down to that 5. That's something that we have to be prepared for. Our most current move needs to try to deleverage these large numbers at $12 and $12.50 and see if we can roll down to 10 within the next week or two. And if it continues in this channel or further down, we can roll again to see if we can deleverage further, freeing up our capital to find other opportunities. So, my strategy, either next week or the week after, before expiration, is going to be to roll these. I have a handful of things I could do with this. I could do nothing and be assigned, and then sell covered calls against those positions. I could attempt to turn this into a straddle or a strangle, which I hope to go over those methods in future videos. Or I could do what I am currently planning to do and roll them down in price and out in time. So again, I want to reiterate, that is the purpose of this series. Practical application. These investing algorithms that you can look at a given situation, narrow down your choices. And I would like to close this video with a resource I have found. The resource I found is this website called the Options Guide. You can see I have the straddles pulled up and the strangles pulled up. They both involve calls and puts, buying or selling. So I had sold puts in the past. I had already sold them. So in future videos, I'll go over in more detail these strategies. The good thing about this site is, even if you're on a strategy and you're not sure what you're looking for or if it fits, you can choose what type of position you want. Let's say I'm bullish. I'm going to choose limited, and we'll leave whether or not it's a credit or debit. And it will find us a handful of strategies. That combination had quite a bit. So there is a strategy or several for a situation. There is no one perfect strategy. You have to read the given situation and see what applies to that underlying at its current price, with its current technicals, and what news and fundamentals that you know about. So I want to wish everybody good luck, safe trading. May your trades always be profitable and your margin never be called.